Welcome everyone to our seventh edition of the Wook in Review. This is Wook Capital's Rod Alsman, Managing Director. Be going through our prepared content, and then we'll open up the conversation to talk about whatever's on folks' minds this week. It's November 4th. Before I get started, do need to let everyone know that Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. So, got some content to talk about this week. Let me share my desktop here. For those of you listening live, if you're listening in Twitter, obviously you're getting the audio. If you are a member of the Wook Discord server, you can listen live in our voice channel and see all of the visuals that I'll be sharing. And the recording will be made available for replay with all of the visual as well as audio. So it's about 4:05 on Friday. We'll run at least an hour, I think, depending on participation. I think there's a lot to talk about this week, especially on the economic front. So let's see where we go. But I'll walk us through a little bit of the prepared content that I have before we see where people want to take things. And if Joe, you have any questions or ways to kind of guide the conversation. But again, I pinned the tweet thread of our latest Wook in Review that Joe kindly put together. I am sharing my screen with the thread, not the thread, excuse me, with the write-up itself. So, the content this week, I think, is a focus on the Fed as well as what's going on in labor markets. There was a massive uptick in layoff announcements on Thursday on the heels of Wednesday's Fed meeting. And it almost felt like people were just waiting to do some of these announcements, but let me not jump too far ahead. So got a few highlights to go over before we get into the core topics. So we talked last week about China and investors bailing out of China, international investors bailing out of the Chinese market. So Wall Street Journal had published this story talking about U.S. pensions deciding to take a fresh look at China. This visual here shows, for example, the Texas Teacher Pension Fund and their emerging markets allocations. And we can see that in September, they made a pretty material shift. They basically halved their China allocation from 36% to what looks like 18%. They bumped up Taiwan, India, and South Korea in lieu of China. So, and it's not just these pension funds, it's some of the more prolific investors or beaten down investors, perhaps. Yesterday, there was news in the Wall Street Journal that Tiger Global, who is, of course, well known for their technology investments over the last few years, going against them, especially the past 12 months, done quite well ahead of that. But the story talks about them hitting pause on investing in Chinese equities, waiting to reassess exposure after she's what we talked about last week, really cementing control, absolute control over the economy. So the story talks about Tiger shrinking its exposure to China to mid-single digits ahead of the Party Congress, and the reality that there's just a lot of uncertainty there. And the story notes that Tiger wants more clarity about how vigorously China will pursue growth and whether they'll invade Taiwan, which if you listen to the Chinese, it sounds like that's a matter of when, not if, although it's obviously an uncertainty. So regardless, definitely some cause effect there. Not just obviously investors don't like seeing prices decline, but the ripple effects of what Xi has done from a policy perspective, really kind of taking control of the Chinese Communist Party and breaking with historical norms. It remains to be seen. Obviously, there was a big rally in China today. We talked about last week the PCAOB, the Public Company Accounting Oversight Board, and the agreement that was reached about audits. There was news last night that I saw it published in Bloomberg finally late last night. It broke a little earlier. Not earlier, it was like 10 or 11 last night, that the PCAOB folks had gotten over there into Hong Kong and had broadly been, I guess, satisfied with what they'd seen. So if there's further headway on that front, that's a good thing. Obviously, the other big question mark in China is when does COVID zero or zero COVID get shelved? And I think that nobody knows for sure unless they're Xi or in Xi's inner circle. But reporting seems to be a view that somewhere around the first quarter that may change over. But remains very uncertain in China, and obviously a lot of folks concerned. We can talk more about China if folks want to, but keep going through the prepared content. Transportation demand falling. So one of, I think, a very useful report that comes out on a monthly basis. If you see, again, my screen, if you're in the Wook server live, otherwise if you're catching the replay, you can see that the logistics managers index, so that's LMI, that's an interesting report. It really looks at costs of inventories, costs of transportation, costs of warehousing, as well as the inventory levels, warehousing utilization, transportation utilization. In a nutshell, since really March of this year, the transportation market has really been rolling over. I have a graphic that's a little small. I'll zoom in a bit here. This is from FreightWaves, who's one of the best market data providers on the transportation side of things. And you can see this blue line declining from March. This line is outbound tender rejection. So this is for truckers. And the way that freight movements work in North America, at least, is that there's contract freight agreements and you have a route guide. This hauler is at the top of my guide. If they're not available, it goes to the next, and so on. And if none of them are available, then I might have to go to the spot market and pay whatever the spot market price is. But what happened really was you had a very, very elevated level of demand, of course, in 2021. This lighter blue line, you see outbound tender rejections were north of 20% for the entirety of 2021, late 20. And that meant that the market was very tight. There was a lot of demand for freight. There was limited freight capacity, and prices went up quite a bit. And now, really, that has fallen off meaningfully in the start of the second quarter, and really through to now. You can see that outbound tender rejections fell from teens, around 20%, down. Now we're in the mid-single digits, under 5%. And what does that mean for somebody who, maybe you don't care about transportation, but it implies there's a glut of capacity relative to demand. And the logistics managers index kind of talks about that. There's been a historical increase in capacity. So it's kind of the worst, I guess, for folks who are hauling freight, trying to make a living that way. It's great for people who are shipping. And it's not just truckload freight. It's something that's been seen in like the Baltic Dry Index, some of the other indices that measure the costs of 20-foot equivalent units, the TEUs, the shipping containers, right? There's been like a 70+% decline in the cost to ship a container from Shanghai to LA over the last year. And those rates continue dropping. Now, they're still elevated versus pre-COVID in many cases. And I had a graphic here that I'll just drag over my whole little notepad. But this graphic here was in the Wall Street Journal earlier this week, just showing spot truckload and contract truckload rates really from pre-COVID through to present. And you can see the black line is contract rates. COVID hit. There's a brief minor decline in rates, but other than that, really rates skyrocketed from 180 to 270, a huge increase in the per mile cost of shipping goods by truck, which 70+% of all domestic freight moves by truck. People kind of take it for granted, I think. Everybody knows listening to me that I'm very interested in it. I know you may not be, but you can see a huge decline in spot rates at the start of the year. And many of the smaller truckers participate and haul freight in the spot rate market. When you think about bigger public companies, which when I say bigger, for example, Knight Swift is the biggest truck hauler, and they have about 1% of the market, and they're the biggest. They have over 10,000 tractors, for example. So it's a very fragmented market. So spot rates declining inherently will lead these contract rates to decline. But what you don't necessarily see when you look just at the top line, right? This is a revenue figure. If you're a hauler, it's obviously an expense if you're a shipper. But if you're a hauler, your costs increased meaningfully since pre-COVID. And pre-COVID was really coming out of a freight recession. For the freight market, it was kind of recessionary pricing. So getting back down toward those levels is definitely not a good thing in the context of elevated fuel costs, insurance costs, other operating costs. So I think there is going to be a lot of pain in freight markets in that a lot of new entrants joined the trucking space over the last 2 years. And for those who are maybe got out or are getting out, that's good. But there's, given this huge increase in capacity, huge declines in rates, there's going to be a lot of pain. And I think my favorite forecasters on the freight economy side are broadly calling for a mild to moderate freight recession to begin in 2023. And freight recessions are not always one for one with broader economic recessions. There was a freight recession, for example, in 2019, and that didn't go in line with a broader U.S. recession, but the freight market obviously slowing down big time as consumers slow down. So just wanted to flag that. Again, we can talk more about it. How much oil do we really need? So I saw two different forecasts come out recently, and obviously everyone has their own perspective. It's just interesting, right? The Organization of Petroleum Exporting Countries, OPEC, you can see the graphic on the screen is what their forecasts have been over the preceding 4 years for oil. And in 2019, if we look at 2022 now, their most recent forecasts, they're close to where 2019 was. They have certainly brought in, and this is a long dated forecast. I mean, we're talking out to 2030, 2040 and beyond. But OPEC is saying that oil demand will continue to grow through until plateauing in the 2040s. Now, that kind of flies in the face of what the International Energy Agency is saying. They have a view that given all of these policy goals to accelerate the shift from fossil to cleaner energy, which again, of course, we talked about the energy crisis a little bit in our 2 weeks ago Wook in review when I was in Vegas. We talked about that, and you talked about the fact that it's not a light switch, right? There's going to be the very long transition. So if you believe what OPEC is saying, they're saying, well, that transition is going to happen over many, many, many decades, because you're going to actually have demand for fossil energy rising for the next 2 decades before finally plateauing. Whereas the IEA is saying oil demand will peak in the middle of the next decade, plateau until about 2050, and then begin to fall. So a little bit of a variance from those two agencies in terms of when those things happen. I think the consistent message, though, is that oil demand will rise, and that incremental demand comes from emerging markets, right? Africa, parts of Asia, different parts of South America are certainly going to have incremental demand. And while this energy transition is ongoing in developed countries, certainly there will still be a need for people to drill, baby drill, which then I flagged President Biden is obviously leaning into his progressive base by calling for these windfall profits on oil and gas companies, which you just think rationally, if I'm a producer and I'm being told I'm going to be slapped with these penalties for producing, why would I produce more? The industry groups, of course, have a view that putting these sorts of taxes in place are going to discourage investment in new production. And I think that's a very logical perception. I think that the windfall profits idea is more of a tax, not a tax, more of a election soundbite than a genuine policy that will get implemented. But we did talk about 2 weeks ago these kind of structural issues with investment in the space, and how companies for much of the preceding, well, really since after the bust in 2014 or so, there's been a huge pullback in investment in the space. So kind of seeing this, it's kind of a, how do you solve this, right? You need there to be investment because demand will rise for many years to come, while at the same time, of course, you do want to encourage investment in the cleaner production. So I think it comes down to improving messaging and maybe a realization that you do need to incentivize fossil investment, domestic fossil investment, which flies in the face of maybe some utopian viewpoints. But we'll see what happens. So I wanted to flag that about kind of these different views from oil producing countries. Joe does a great job putting together all of our content and kind of cleaning things up after the fact. So if you haven't checked out the Wook YouTube, it's at Wook Capital. Joe puts up all these Wook reviews. There's some other content from interviews that I had done previously that's up there. So again, if you want to check that out, we certainly welcome you to, and we certainly welcome any feedback on the types of content that we put out as we look to improve this and make this a valuable usage of your time. So, okay, prepared content. It's 4:20. So spent 15 minutes going over those highlights. I'll spend maybe 15, 20 minutes walking through some of this. Again, if you're just joining, the visuals are available live in the Wook server. If you're not a Wookie yet, wook.gg in your browser, very easy to join. We simply ask that you introduce yourself in order to get full access to the server to try and minimize spam. So Wednesday, Chair Powell noted we have a ways to go. We need ongoing rate hikes to get to that level of sufficiently restrictive. And I'm going to pin, I had put together a thread on Wednesday while the chairman was speaking at his press conference. So I will pin that to the nest here for any of you that didn't yet review it. It's not a pure transcript, of course, but I tried to capture the main, the majority of it. So I just pinned that to the nest. And look, the Fed Open Market Committee unanimously voted to raise the target Fed funds rate 75 basis points, fourth time in a row. Now, this is an unprecedented pace of hiking, as folks like Kathy Wood have pointed out. It's also an unprecedented once-in-a-century pandemic response that the Fed found themselves slow to react. And we can hate on them and be mad at them as much as we want, but at this point in time, they have to go by the data that's available to them. And we're going to talk about kind of the mixed data. There's some consistency in it. There's also some mixed messages. So we'll kind of talk about that. So what it really boils down to is the Fed still sees a deeply misaligned jobs market. The quantity of labor supply in the country is not something the Fed has control over, right? They don't control immigration policy. They can't directly tell your lazy uncle to get off his butt and rejoin the labor force after being out of it for years, or whatever incremental labor supply there may be. He could, I guess, indirectly, by destroying asset values, pull grandma and grandpa back into the labor force if their retirements are, if they took an early retirement, but that's not really being seen yet. So we've got jobs data that came out, right? You get this very delayed, some of these data points are very delayed, and that tends to be the issue, because the Fed is really looking at personal consumption expenditures, PCE, core PCE is their policy guide to get to 2% PCE. And that data is inherently lagged, as is the jobs data that they're looking at, right? So we got earlier this week the September job openings JOLTS report. So I have it on screen. You could probably just Google JOLTS report if you wanted to kind of skim it yourself. But in a nutshell, there's still like 2-for-1 job openings to every unemployed but seeking work American, which is just very out of whack with any sort of historical level. There's question marks about like how many of those openings are not just maybe duplicates or employers trying to pad their rosters, so to speak. So like it's not a perfect number, but it's a lagged number. So this is from September. And then this morning, we of course got the October jobs report. So payrolls grew again, another very solid month, 261,000 incremental jobs in October. And there was a little bit of noise. Unemployment rate ticked up to 3.7. So I think it was a 10 or 20 basis point increase. It was the slowest rate of labor ads since December of 2020. However, it's still, when you look at that misalignment between so much demand for labor and the relative lack of supply to meet that elevated demand, right? You look at the labor force participation rate, the prime age labor force participation rate, and I believe it's gotten back to pre-pandemic levels. I'm pulling it up from the St. Louis Fed now. So if I can reduce this graph to, so you can see that the October data point is 82.5% of 25 to 54-year-olds Americans are in the labor force. And that compares pretty much with where things were ahead of the pandemic, which was a pretty darn strong job market. So labor force participation has recovered and has gotten back to that level for at least the core. We could have an interesting conversation when we kind of welcome input on like what people think about younger labor force, so the 18 to 24-year-olds, that's lagging, and then the 55 plus year olds, that's where you're missing your participation a little bit. And also, as I've mentioned multiple times, you have the cumulative effect of lost millions of immigrants from both the prior administration policy, COVID, and the current administration not necessarily moving swiftly to enable legal immigration to try and get that supply fixed. So there's supply issues in the labor market that, when you look at that participation rate, it's like, okay, you can only squeeze so much blood out of a stone. So there were, as I mentioned, a lot of announced layoffs that came out on Thursday. They were across the spectrum. It was Apple's, Amazon's, your mega caps. It was your Lyfts, and then your big startups and small startups that have mostly gone public, like Stripe. So I pulled a couple things here. So I pulled this layoffs.fyi, which is, I think, a very interesting tool. I don't know Roger Lee, who maintains it, but they basically, I believe I don't know if it's crowdsourced or if they manage it 100% themselves, but they have data on all of these different startups that have had layoffs since COVID, and obviously these layoffs are not related to COVID, but I think that's just when this began. So I have a kind of chart up that I included in the newsletter, and you can also see on the site. Kind of, we're in November. Today's November 4th, and you can see that even only 10% of the way into the month of November, the count of employees laid off is basically on pace to be 2x the highest month year to date. So it does appear that there is an inflection in terms of layoffs ticking up. It's chiefly coming from sectors that have been more reliant on cheap capital, like the technology space. It's not only that space, but that's where you're seeing layoffs tick up. And then when you look in the jobs report itself, though, you can see that it's sectors that are strong still. If I can find where it said, it talked about healthcare. It talked about, so yeah, you're seeing sharp hiring slowdowns in some industries that are particularly sensitive to interest rates, is what the Wall Street Journal notes, which is unsurprising, right? Any housing related labor is being impacted now. So what I thought was very interesting, if I didn't just accidentally exit out, was this email, from Stripe's CEO. So Stripe's CEO, Patrick Collison, sent this out yesterday to Stripe employees. And they're reducing the size of their team by around 14% and saying these nice things and blah, blah, blah. I think what it boils down to for me, though, if you were to scroll down to the why, is the bullet in the going forward section. We were much too optimistic about the internet economy's near-term growth in 2022 and 2023 and underestimated both the likelihood and impact of a broader slowdown. So it's not unique to Stripe, but a lot of these tech companies, and I think many of us are victim to it too. We saw COVID hit, consumer habits shifted. They were forcibly shifted, right? People were forced to consume digital intake as their form of order placement, or they'd have to place, pickup and curbside and all sorts of things that maybe they had never done before. So you saw huge upticks in like e-commerce adoption and growth rates. And a lot of these companies thought that those rates would continue at elevated levels. And of course, none of us knew what would happen, but they made bets. And unfortunately, those bets are not paying off because consumers are shifting back to pre-pandemic habits to an extent. The growth that was expected is not there from both a mix, I think, between like digital and physical consumption. There's the shift from like goods back to services because people weren't able to consume services at the same clip during the pandemic and overconsumed goods. There's only so many couches one person could possibly order. So players like Wayfair are feeling the pain there. But I think that message from Collison succinctly kind of hits the nail on the head. It's a combination of being wrong about what the rate of growth would look like coming out of the pandemic, as well as what was beyond their control, right? That the Fed would have to slam on the brakes with regard to interest rate policy and need to slow the economy in order to get inflation under control. So and we talked about this, I think the first time we talked about the Fed, we talked about how the summary of economic projections that the chair put out, implied that there would be like 800,000 incremental job losses by 2023, by end of 2023, based on their September expectations, which is very real. Those people have families, have bills to pay, that there's pain. And that was the Fed, I think, trying to paint a very soft landing picture. And if you listened to the chairman, the last question he received on Wednesday was whether the path to a soft landing has become narrowed. And I think he acknowledged that it has narrowed. He is, of course, not going to say that there's no chance in hell, but he certainly, I think he noted when he said that when the December summary economic projections come out, we should expect rates to look higher from September. I think that when you look at the economic estimates, you'll probably see a further uptick in the expected unemployment rate, which even then is likely to lag reality, because I don't think the Fed is wanting to put out in public that there is an expectation that a million or more Americans will be losing their job in the next 12 months. But there is definitely a shift, right? These layoff announcements, these hiring freezes happening at tech companies. Eventually that flows through to other sectors of the economy that will feel that impact. So it's definitely, we heard Fed speakers come out today and talk about, the pace of hikes will slow inherently as they've gotten up to the current Fed funds target, which is 375 to 400. Um, I'll actually see right now what is priced in terms of the December rate hike. So it was about a coin flip heading into the FOMC meeting on Wednesday. And after today, the odds of another 75 basis point hike have fallen down to 36%. This is the CME's FedWatch tool, which I think is an excellent tool to see what's currently priced in to markets. So about 2/3, 64% are a chance of a 50 basis point hike in December. But if you take the Fed at their word, it sounds like just because they will ratchet back from these outsized 75 basis point hikes, it does not mean that they are ready to stop, and that the terminal rate may be closer to 5 or above 5%. So we'll have to keep seeing what happens. And I think that a lot of prognosticators' view is that the Fed will continue to tighten until something breaks. They're obviously looking at lagging data, but they're not ignorant, I think, to seeing what's happening in real time. So they included the statement in the most recent release that, which I'll pull up. It was along the lines of the lagged effects, the cumulative effects of. Let me not butcher it. Let me actually just read the statement to make sure I'm not butchering it. In determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial development. So when they put that out, the market rallied at 2 p.m. on Wednesday, seeing that addition of that language. Then when the chair took the podium, he definitely came off pretty darn hawkish. So there was a point at which he was asked about markets rallying and how he felt about that, and he turned on Super Saiyan Hawk mode, J-POW. So clearly the Fed does not want financial conditions to loosen. They do not want financial assets to be increasing in price. They need financial assets to decline in value. And fighting the Fed is not proven to be an effective strategy for many years, whether long or short. So it does seem like the Fed's intention is still for asset values to decline. And of course, the Fed doesn't really care about asset values. I mean, they do and they don't. They care about their two real economy driven and targets of maximum unemployment and stable prices. And right now, the chair's made it very clear that without stable prices, you cannot have maximum employment, excuse me. So the fight is to get stable prices. There's a lot of good things to look at from a leading perspective about rents inflecting negatively, what we just talked about with transportation prices inflecting downward, and all of those will eventually flow through to personal consumption expenditures and consumer price index. But for now, there's a lot of delay in that. So the Fed is aware, as they say in their statement, of economic and financial developments, seeing that huge uptick in layoff announcements yesterday. I don't want to say it's something they want to see, but it is. They do want to see demand destruction, labor demand, and consumer demand. So one other data point I'll pull before I get off of my spiel and open it up to see where we want to take the conversation was having a brain fart now. Well, it's all good. I forgot where I was going. Joe, what do you think? Is the Fed breaking shit?
How much do you think? I mean, at this point, we've seen tech fall this much this year. How much is that priced in?
I mean, that's the magic question, right? Like tech specifically. I mean, I think we've talked in the past about how rich earnings multiples remain if you have the view that forecasts are still too high, right? I think on Wednesday maybe we were talking about it when I had held that open mic, but like if you look at the Nasdaq, for example, the tech-heavy index, it is still more than 10% above pre-COVID levels, pre-COVID highs, which I don't think there's anyone in the world who would argue markets were cheap at that point in time. I mean, maybe there are. I guess let me not say anyone. I think the consensus would be that valuations were pretty rich. Now, granted, that point in time, interest rate policy was still very accommodative, right? You still had very low interest rates, which if you're making a long-term valuation driven approach to these equities, if you're plugging in a 2% 10-year yield, there's a pretty huge change when you plug in a 4% or 5%, and how much that discounts those long dated cash flows, because that's of course what these people are buying who buy these tech startups and tech companies. They're expecting significant growth and future cash flows 5+ years out to be very impressive. And when I just in the context of the change in interest rate policy and acknowledging the economy is still doing pretty well, even though we had the negative GDP prints in 1Q and 2Q, there was a lot of import noise dragging in 1Q in particular. 3Q, of course, came in and it was a positive 2.6. Like the real economy, I think, is still doing fairly well for most of the data. So the way I see it is it's not fairly priced. It's pretty richly valued. Technology in particular in this context of if the Fed is going to keep rates at an elevated level, then they're very richly valued. Now, if you have a view the Fed is going to pivot and cut rates, then it could make sense why you might want to be buying up technology companies at these levels. But I've never been a tech investor. I never will be. That's just not me. And to each their own. Nothing wrong with being a tech investor. It's been a great decade for tech investors, right? You look out here on the max chart, the QQQ is up 400% all time, going back to 99 even when it was already pretty juicy. So it always gets back to what's the duration. But I think if you were to look at the short duration, 1 year, less than 2 years, there's a lot of economic headwinds. There's the rate headwinds. You need to look at, when you're looking at these tech companies, you definitely need to look at like what's going on in the capital structure. The ones that have a lot of debt and can't necessarily service the debt, especially if those debts are variable rate, like you're going to potentially face in a recession, your revenues coming down, you're going to de-lever, you're going to see your profitability coming down, and you're going to see your interest expense rising. So you're really going to get pinched all across the board, and that's not only technology, but I think it's hard to make the argument that technology is cheap at this point. And maybe it'll get there. Maybe it'll overcorrect, but that's kind of my thinking on tech.
Do you think Musk gets sued over the layoffs? Because there's already been complaints that he didn't file a notice soon enough that he was going to be laying off this much of the labor force.
I'm sure there'll be lawsuits. The WARN Act, I know, requires advance notice, but for a couple of exceptions, it doesn't seem like his situation in Twitter meets those. I saw mixed messaging on whether the folks being laid off today from Twitter, which in Twitter's case, it was about 50% of the workforce. So, I noted these other layoffs being announced and coming through, and we're talking about teens, maybe 20% generally. When we're talking about these other startups that made these announcements, I'll just flash on the screen what came through from layoffs.fyi. You got most of this stuff in the teens, but then Twitter 50%. I mean, that's a big number. It does seem like the guy just lives his existence flying by the seat of his pants. I mean, he had more than half a year to plan what he was going to do with the business that he agreed to pay $44 billion for, and it doesn't seem like he did anything until after he bought it. Uh, so yeah, if he is in fact going to pay them 60 days and he just let them know that they'll be gone, I don't know. I'm not a lawyer. I don't know if there's if that gets him out of that need to have provided the advance notice. But I'm sure, as with all things Elon, there will be lawsuits.
Yeah, probably just go whichever route is cheaper, paying the fines or paying them like 60 days.
Probably, I have to imagine those former employees won't be that interested in paying him $8 a month, though, for Twitter Blue. But anyways, we kind of completed the prepared content that I had. For those of you who are just joining or joined late, we walked through the Wook and Review newsletter that we sent out this morning, which touched on transportation cost, touched on what's going on in oil demand looking out many years, touched on obviously the Fed this week, as well as what's going on in the labor markets, and also a little bit about China allocations. So if anybody wants to come on up, add any perspective, or ask any questions pertaining to any of those topics or other, it's 4:45. Plan to run this, as long as we have some interest, maybe through for another half hour or so. Um, Jimmy, appreciate you being the one to bite the bullet and share your thoughts. How's your Friday going, sir?
How you doing, Rod? I'm shopping at a Whole Foods right now, just grabbing some groceries. Had lunch in a nice little food pod here in Portland. They've got a nice little setup where people just kind of, grab some beers, grab some whatever. It's a very hipster life, although that's not necessarily my MO. I wanted to talk about the FOMC, SaaS businesses, and Twitter. So, like you mentioned, it was during the conference call, and this is like toward the end of the call. Like the notes were pretty dovish. Powell's definitely more hawkish, but like that idiot at the end who didn't check his phone, like clearly the markets had started selling off already. But like when he said
Yeah.
like, "Oh, the stock market is up," I mean, he was asking for the smackdown. Like he was fumbling over his questions. He sounded like a complete doofus, and like Powell gave him the stank eye. He's like, "Oh, you made me have to do this," so that is what it is. On SaaS businesses, I've invested in tech in the past. Like I told you guys, I invested in some of these companies before they blew up, to the upside and the downside. Roku, I got in the low 30s. I can't believe it's at $40. I was in at C at $12. I wish I'd held on all the way till whatever it got to, like 300 or something. But the promise of high margins, cash flow, and TAM was so tantalizing. But it turned out that the market really rewarded revenues. So we got to this point where the cash flow never materialized. I think Jeff Bezos famously, back in the day, he once got grilled for CapEx spend, and he like turned off the spigot, right? He didn't spend any on advertising, any on anything, and just printed cash. And after that, that was like a seminal moment where they never questioned his long-term vision, growth, TAM strategy ever again. But here we are. Look at Meta. They're burning all their cash flow. For those of you that listen to the All In podcast, they're gonna, if they spend $25 billion a year, they've got this VR AR moonshot over 10 years. That's $250 billion. They need something more to show for it. And frankly, whether it's Carvana, all these other companies now, you're seeing the roosters come home to roost. Even Roku, they're still in this environment. Now their margins are deteriorating. Their platform revenue margins are kind of in the mid 50s and not in the high 60s. But like these companies still spend, like they're going to grow forever. And so it makes me wonder, how much of the G&A, the R&D, the sales and marketing, which is all below the line, but substantial, the stock-based compensation, how much of that is required to maintain the revenues, right? And how optional is it really? Because on the surface,
Yeah.
these tech businesses have 80+% margins. They sound beautiful, right? The incremental user has no cost. It's all revenue, blah, blah, blah. But like, can these guys actually do it? I don't know. So
yeah, that's
yeah,
the
we'll find out.
multi-trillion-dollar question,
Yeah.
right? Your, your point about it was interesting if you watched the presser and that guy chimed in like, I don't know, was he just using some crappy free delayed 15-minute delay and he saw, oh, prices are up and when he made his question, because yeah, it certainly led to the next leg down. And I saw the last 90 minutes of trading, it was the worst in the history of the Fed announcement days in which they announce interest rates on the same day. I guess going back to the early 90s, I think it was. But that obviously wasn't good. It wasn't a good look for him. And yeah, Powell had laid a smackdown. Yeah, but like you're right. Like the allure of these software businesses, which again, I don't know anything about software businesses like that. I've never invested in them. I understand the allure of every marginal customer is just marginal cash flow for you, and you have high gross margins. You have if you have a sticky service and you have a big addressable market, as you noted, that people can get super hyped up about that. And obviously, for the last couple of years, people did get super hyped up about that. Earlier on, we were talking about Tiger Global, and they have taken it on the chin, but they were investing insane amounts. They and SoftBank were investing insane amounts in all of these technology startups, and the promise is, yeah, you get to scale, and then you pull back on spend, and you're just printing gobs of money, and it just doesn't seem like that works out for most of these companies. Whether they have then like a structural issue with SG&A, not SG&A, excuse me, SBC, share-based comp, just being eating away at the free cash flow. Because like you'll see these companies report, oh, we're buying back this much in stock, and then it's like, okay, well, how much did you actually buy back? You didn't. You kept your share count flat because on net your buybacks simply offset your issuances to your employees. Which look, I get it. Employees, if you want to attract top talent, you're going to need to pay them. I'm not saying they don't deserve to be paid well per se, but I think that some of the stories that tech investors told themselves, like it was only enabled by zero interest rates, and I think it's a withdrawal that the sector is going to have to face, a withdrawal effect of going away from ZIRP and now facing real costs of debt capital and less willingness of investors to just flood them, with the super soaker of hey, we have to turn you down because we have so many people who want to invest in us at this price. So it's just a very different environment, and I have to imagine there's going to be a lot more pain before, quote unquote, the bottom. A lot of these tech companies, it's like, oh, they're trading at 2017 levels, 2018 levels. You noted Meta, of course, trading at like 2015 levels, and Meta has its own issues, which I think I forget if we talked about in the last book and review or if it was a different spaces that Joe and I kind of open mic space we did on Wednesday, where when you have these tech companies that have dual voting classes, where somebody like Mark Zuckerberg owns an eighth of the company, yet has the entire, he has majority control because of the dual class structure. Snapchat is another one, and Google has the dual class. But historically, over the last decade, those companies have been able to raise capital, have traded at a premium. And I think the reality is, if you have a controlling shareholder who public investors, you couldn't have had an Elon Musk step in and buy Meta because of that dual class structure. That's why he was able to buy Twitter, because they didn't have a dual class structure. Whether it's a boondoggle or not, I think that you actually need to see a discount, not just tech. It just seems like tech is where these dual class structures have come about most, but these are not shareholder friendly, not friendly for public shareholders. Public shareholders are simply along for the ride. And if they decide that they don't like the ride, well, yeah, Meta is a prime example of what happens when that music stops. I know Dog, Mr. Alpha Hound came up, as well as Mr. Sick One. You guys want to add anything on the technology side or shift the topic?
Well, I kind of want to shift the topic that's kind of related, but I can hold off until Alpha decides to speak.
Well, yeah, I just wanted to add on to that because I totally agree that I think the sort of mega cap tech phenomenon of the last really market cycle, right, is just a Frankenstein of the zero interest rate regime. I do have some hope though that going forward, right, the stock-based compensation maybe is not a permanent fixture of those businesses. You know, I kind of think of it in terms of you look at the banking industry prior to 2008, right, the compensation post that got reined in a very real way. And I wouldn't see why if the tech industry is going through a reckoning now, that's just part of that kind of transition as well, right? That the policies that accommodated such a ridiculous comp package to the employees is gone, therefore compensation comes down in total, right? Like maybe you replace equity comp with more cash bonus. I don't know how you do a clawback provision, but I'm sure they'll find a way. Some of those features, right, just as the interest rate regime changes, I'm sure you'll see the sort of equity compensation to employees change as well. But yeah, it's crazy that you have. Go ahead.
I was just gonna say, like the biggest irony is like when the company is trading at 10 times sales, 20 times sales. If you're the CFO, paying in equity is the prudent thing to do because everyone knows it's overvalued. You're not going to take your hard-earned cash or cash that you don't have or the cash that you're trying to preserve to grow. I mean, you're going to give people shares, and so it was a self-fulfilling prophecy, right? Until it wasn't.
Well, that's the perversion of an artificial zero rate environment, right? What is the rational thing to do in the proximate sense is kind of in the larger, the larger picture and over time, not an iterable process. It doesn't actually make any sense. So you're misallocating capital because it's the rational thing to do in that moment, but it never should have been that way in the first place.
And just one thought on tech before we let kind of see if you can take us on a tangential direction is what happens now if you're an employee at Twilio, at insert tech company of your liking that is down 80, 90% from all-time highs. All of your equity is, I don't want to say it's worthless, but it's certainly down a lot from where it was. If you're an employee, I think these companies are going to face a lot of retention problems. And obviously, in the context of the current conversation we're having, where they're having layoffs anyway, maybe that's fine by the company. But I think if you're Meta and you're trying to attract the best and brightest to build the metaverse, I feel like that's a real headwind that they're facing. What are you guys seeing there? Or have you heard that from anybody you know that works in industry? And if no one knows or has a good answer to that, that's fine. I mean, I just think it's a question worth posing.
I mean, I know a few folks that work in the tech industry, and it's sort of like the jobs are good still, right? Even if the stock-based comp is down on paper, like the all-in comp package is still good, and it's sort of where else do you go, right? Like the only industries that really pay comparable to what you'd be making if you're an engineer in one of these mega cap tech companies is tech or finance. So it's like you sort of don't really. It is what it is, right? Like the options available to you going forward aren't that different, and you can't go back in time and get your equity comp back at a different strike or something. So you just kind of have to accept it and move on.
I think the point you made before I let Sick chime in, and again, anyone who wants to come up and share their perspective is welcome to. The point that you made that it's going to be like what happened in 08, 09, like the financial services industry hasn't gone back to the way it was before. I don't think tech goes back to what it's been when we come out at the other end of this, wherever the other end, settles. It does seem like the era of ZERP is dead. Saying that now, right? Watch, we fast forward a year and the Fed's back at zero somehow. But
could happen. I had one final, just quick note off the bat because Joe asked the question at the beginning, right? Is tech still overvalued? And I've made this point in the Discord a couple of times, but like the very simplistic measure in my head is that the earnings yield on Apple, which is arguably like the safest, sanest of all the mega cap techs, is about the same as the real risk-free cash yield on the 10-year, which just doesn't make any sense, right? Like either Apple needs to come down a lot or the Fed actually does need to pivot sometime very soon and cut rates back to zero. So like that, incompatibility has to reconcile eventually. I don't think it's that they're going to pivot and cut rates back to like 2% or 0 and sometime next year. Right? It doesn't seem that likely given where inflation's at.
I shamelessly just put up in the nest what I had said, I think it was last week, in line with what you were just saying. Apple is yielding on a enterprise value yield, the free cash flow to EV yield is basically the 10-year yield. So like, why are they just buying back shares at these all else equal pretty rich valuations and not doing stuff like special dividends or just bumping their core dividend if they don't think it's something that's one-off? But I don't know. We'll see what happens on the back end with Apple. I mean, I think everybody's listening knows my personal view is that it's got a lot of downside, despite being the last of the generals to fall. But we'll see. Sick, please. Where were you going to take us?
Well, it kind of wanted to touch on like the whole tech side, and well, for me, like I work at a media company, and I'm kind of curious about like what your guys' thoughts on like studio related stuff, like maybe Netflix or Disney or NBC Universal. Mainly because I noticed, like for instance, like when Netflix took a big haircut, like down 50% earlier this year, they cut a lot of people only to like hire a bunch of them back, then fire them again and hire them back. So in terms of like the job market, like its own version of its own bullwhip effect. Same thing that I've noticed after talking with some of my buddies over at some of the other tech companies that also deal with some of the metaverse stuff. Like they have to either cut or bring them back in, or at least by project basis. So like there's really no stability. But in the long term view, with what's been happening with the rates going up and like Jerome Powell unlikely to pivot anytime soon. What's your guys' view on I guess like the media company and I guess like advertising going forward because of the question mark about the pivot?
I mean, advertising is a cyclical business, right? So I think when the economy is growing and companies are spending money, right, any of those advertising aligned businesses, which also includes Meta, right? Like you think of Meta just as a advertising ad tech company, really, it's what their revenue's coming from. When we're in a bull market and those companies are spending money on ads, great, right? Advertising is a great business to be in. It is also one of the earliest things to get cut when there's a downturn. So I would expect to see more of the same. I'm by no means an expert in the media industry, but the idea of you let go of people and then bring them back in, or you bring them back on as consultants or something, project by project, that's kind of a standard playbook, I think, whenever a company downsizes. So, if you assume that they had essentially zero cost of capital for the last, however many years, and now all of a sudden it costs money and the revenues are falling off and the next 12 months forward doesn't look as good, right? What else would you do? You need to start cutting your own fat.
Well, something that I did also want to like point out, a lot of companies on the studio side are actually spending a lot more money than I thought they were, and like projects are actually picking up. Well, again, this is all short term for right now, but it's like as if the best way I can explain it, like about like a year ago when the pandemic hit, a lot of the productions just shut down. I guess like the content creation side, and now they're starting to really pick back up again, even with the downturn and the pivot. So, actually, I'll be honest with you, I have no idea like where like in terms of like the media or like the stock price in these media companies are going to go. I'm just kind of want to poke at your guys' thinking on this also. But yeah.
Yeah, so I think it's worth kind of separating out the stock price of any of these companies from what they're deciding to do capex wise, right? So if they committed financing to these projects a year ago or 2 years ago, right, those are decisions that have already been made. And if they have the money, right, why would they pull them now? Maybe some really foresighted CFOs would say, hey, let's not actually do that. But once you start a production, I'm assuming there are costs to ending it, right? So it's sort of like past a certain point, sunk cost fallacies do have real world consequences. And it in general, like the economy is a super tanker, right? It takes months for the effect of the rate increases to really flow through all the different layers in the economy. So it could be that, studios committed funding to this months ago and they haven't started feeling the pinch in the same way other businesses have. And until then, it's full steam ahead, and they're just later down in the cycle. In a few months from now, that will change as well.
All right. Well, thank
I would
you.
just add, like, I agree with much of what Alpha was saying about both advertising being cyclical and inherently it's going to see declines, even if the march is toward digital advertising, that the absolute spend must decline and will decline in a recessionary environment. And with regard to like these media companies, it's certainly not my wheelhouse. I've never owned Netflix. I've been looking at Paramount, which looks like it may end up being a value trap. Mr. Buffett obviously has bought it at higher levels, and not that he's foolproof, but we'll see what happens with it. But the thing that I look at with a lot of these media companies is like they have a lot of debt. So I was looking at Paramount, and I had it up on screen for those who are following along, and the EBIT to interest expense ratio is under 3 at Paramount. Not that they're the only media company out there, but they have a lot of interest expense. And then in the context of what's their debt structure look like, is that variable rate debt? Is it all fixed? If it's not, they're taking that pain, and it costs money to produce this stuff, right? And I think that what I've heard a lot of the Netflix bears kind of point out is that you never get away from having to spend. They will always have to spend. So that it's a little bit disingenuous, maybe some of the representations of media companies in the context of, it's just going to be a fight forever on the spending side. But I don't want to say too much there. I'm not an expert in that space. If anybody is a media expert or has studied the space extensively, I would certainly welcome you to come up and chime in. But with what Alpha said, I mean, that makes sense to me. If you've contracted for things, depending on how expensive your switching cost is, you're going to go ahead and produce that, but you're probably going to be pressing pause or pulling back in lieu of what you're observing in the real economy.
Yeah, that's what I'm trying to figure out right now too, because like my job in a weird way is like tied in with the stock price more or less. Because like after watching Netflix took a big hit, a bunch of my friends got like laid off and only to be rehired like a couple months down the line, depending. So it was like the weirdest thing.
So were they rehired as full-time employees or as contractors? Because there's like a bit of an accounting. Yeah, go ahead. Sorry.
A little bit of both, depending on what their job was needed for, which I can't. I'm not sure if I'm completely open to say, but
that's okay. Yeah. I mean, the gist of it is that there's different accounting treatment for spend coming from a full-time headcount versus a contractor. Rod is the accounting guru here. I'm not, but you basically have to amortize the cost of projects worked on by full-time employees and consultants you can expense in the given year. So, just sort of balance sheet financial engineering, a lot of companies will pull that trick if they think that the stock is under pressure and let people go, rehire them as consultants, and effectively their net headcount stays the same, their spend on labor stays about the same. Usually actually ticks up a little bit because consultants are more expensive. But it could just be some of that, right? Like there's all sorts of financial engineering and fat cutting, which is a normal response, I guess, from management if you see your stock tanking like that.
Yeah. I mean, like I would love to hear more. I guess like people more on the media side or the advertising side in terms of like how to like gauge a company's health essentially to avoid value traps or investing, or if I should just like hold off and buying my company's stock employee program or something like that. But all right.
So in general, it's like a little tip. If your income, your paycheck is coming from a media company, I would suggest investing in something else just so that you're not sort of double exposed, right? Because you think about your wealth in the future, a huge portion of that's going to come from your earnings, which is already exposed to the media sector. So investing into other things does diversify you, unless you're like truly, expert in media and know the ins and outs of the business and think you can perform better there than anywhere else. But I think just for diversification, I would look at other industries.
Yeah.
I
But from my
would totally
experience,
second that, and I would also say it also, you mentioned like if there's a stock purchase program, like depending on how that plan is structured, you may be able to take some risk-free or near zero risk. I don't want to call it alpha, I guess, but depending on the way they structure it, giving a 15% discount, but you can turn around and sell immediately type thing. Like you should turn around and take advantage of that and sell immediately. I mean, going back many years, 20 whatever years, thinking about Enron and then, touting that you should get your 401k all in Enron stock for Enron employees. I think most of those folks would have certainly rather been diversified outside of Enron. Not saying that the media company rats in Enron, but I would agree with Alpha that you're definitely like you're already heavily reliant on, your wealth is heavily reliant on that sector. So diversification certainly wouldn't hurt. But RE and ESPP, yeah, definitely try to take any free money or near free money you can.
all right. Well, thanks, guys, for that.
So what else happened this week? We also got the ISM report that comes out on the 1st, the manufacturing PMI. My former coworker, Tim Fiore, is the chair, and I think anytime you catch him on media talking about what he's seeing in the economy, the guy is just a deep well of knowledge, super smart, super tied into the manufacturing economy. Put it up on screen for those who are looking, but the report basically shows that the expansion is really about to run out of steam. Like the October manufacturing PMI was 50.2%. It's a dispersion index. So if it's above 50, it's expanding. If it's below 50, it's contracting. So it's right there. It expanded slightly in October, down from 50.9 in September. So if that trend were to hold true, then November would show our first contraction in the manufacturing economy. When you look at the bits and pieces of it, there's a lot of good stuff for pricing in there, right? Prices paid decreasing, new orders are contracting, which is definitely viewed as a big leading indicator. So, the manufacturing economy is flashing kind of like a yellow light. I would say it's not like a red flag yet, but if anybody, either those who are up as speaker or anyone who's listening, if you're tied into the manufacturing economy, I'd love to hear what you're hearing, what you're seeing, and certainly would welcome Jimmy and Alpha. There's obviously a lot in the pipe for certain aspects of the manufacturing economy to be supported from the infrastructure bill, from the Inflation Reduction Act. So certain spaces are going to have that fiscal support. Other ones are not. So, it's hard to get say broadly, manufacturing is screwed or whatever. I'm not saying that. I do think though that it's obvious that things are slowing down, and the good news again is the prices appear to be coming down. Prices paid are now in a contractionary state. So these are good signs, right? If the Fed is obviously seeing these sorts of things as well, but clearly they're still hyper focused on labor as opposed to necessarily production and manufacturing. But yeah, if anybody has any thoughts on that report, was another kind of one that I think everybody should be, if you're really tied into this stuff, the monthly PMI on the 1st of the month is definitely a must read. And I'll just read off Fiore's quote. Well, if anybody wants to queue up or have a response, Fiore noted that, quote, the U.S. manufacturing sector continues to expand, but at the lowest rate since the coronavirus pandemic recovery began. And I won't read his whole quote, but I think that's it in a nutshell. It's slowing. The rate of expansion appears to be inflecting negative. Yeah.
So I'm not particularly keyed into the manufacturing economy, and what I do for work. It is nothing, no real tie into anything real. But I do think it's a good jumping off point to talk about the difference between effectively real companies that do real things, and sort of I won't say like the vaporware economy, because we sort of talked about tech earlier, but I'm kind of thinking about it in the terms of like when we're talking about the price of a stock, right? There's the underlying cash flows that you could value similar to a bond, right? You just sort of do a DCF and make some reasonable assumptions. And then there's like the fluffy part of it where those assumptions get out of control, and some sectors, some businesses are more dependent on those assumptions than others, right? So I sort of view manufacturing as like that's almost right. That's the Dow Jones, that's the S&P, it's the real economy type stuff. And then there's the fluffiness, which is really like the Qs and all the tech companies. And where we've come so far with rates being, close, a little above 4% and probably going towards 5, like the obvious shitcodes have been taken out. But like, I guess my 2 cents on that, right, is if rates actually go above 5%, which I think they reasonably can and will, like those shitcodes shouldn't just be down 90%, they should be dead, right? And that's
And
where you
many
also then
will, yeah.
see, yeah, and that's when you see like the real world economy stuff, like manufacturing, also starting to show the signs of weakness. That it's not just like the fluff that was pumped by free money. It's
And
like
we've started to
real.
see it for sure, right? The last month, that divergence. And again, if you're seeing my screen, you can see I'm kind of showing the major indices. But you can see that from really the beginning of October, the Dow had been down on a 1 year basis 20% or 22%, excuse me. It is now down 10%. September 30th, the NASDAQ was down 32. It's now down 33. So the Dow has rallied meaningfully. Your point, the real economy, these companies, many of them make a lot of money, and they've kind of been laggards for some time. They have been out of favor, if you will. So whether there's a meaningful shift to come still, none of us know for sure, but generally speaking, a lot of those companies are not expensive especially on a trailing earnings basis. The question is just if a lot of them are cyclical, right? If they're industrials and the real economy is in fact slowing down, or is no longer expanding, as we kind of just talked about the ISM data showing. Again, it's of course sector by sector within that, but those real co's in the last month, you've really seen a breakdown in the correlation between, the technology companies and the Dow. So will that continue, right? Or is the Dow about to take a next leg down? I mean, I certainly don't know, but I thought that was notable that you hadn't really had that divergence until last month or so.
And that's sort of common, I think. Like, so if you think about it from like let's make it simple, right? Like value versus momentum, you split your universe of stocks and not in half, right? But you try to separate out like the top 10% value stocks, bottom 10%, top 10% of momentum stocks. You see in a major drawdown, like everything draws down, but it's those value stocks that don't draw down nearly as much and then roar out of the drawdown aggressively once the overall market starts climbing again. So like that's perfectly consistent with every other bear market we've seen for like the last 100 years or so. I think even Ben Graham calls it out. I've forgotten which book, but basically, right, like if you were investing during the Depression, if you bought the high quality companies that showed good price to earnings, like you were back to your 1929, peak portfolio value within 5 years, I think, instead of the however many decades it took for everyone else, the overall market to get back to flat. So I don't know, but I'm bearish. So I think that the Dow Jones will keep going down. Every stock basically will keep going down, but the real co's and the ones that are well managed and have good capital structures will definitely not go down nearly as much.
And there isn't the existential risk, which I think you point out validly, that if rates end up getting around 5%, and if there is in fact a big drop off in revenues and cash flow for these other companies, that many of them have historically been reliant on capital markets to tap equity offerings, convertible bond issuances, whatever. Debt markets are certainly not a great place to need to be tapping now either, if they could even get them. So hopefully you have a balance sheet that can make it through this challenging time. Even if your stock's down 80% right now, it can go down another 100%. It can go to zero. So I see a lot of people talk about, oh, these stocks are down, 80, 90%. They can't go down all that much more, can they? Well, whatever you buy, it's
well,
not
yeah.
like
So
it can only go down 20 or 10%. It can go down another 100. That's how the math works.
it can go to zero, and then similar to that, right? All the commentary around like net short futures and put positioning being at all-time highs. Like you got to remember that the market has blown past all prior all-time highs as well, right? So notional values of everything are at all-time highs. So seeing things like that, they're not particularly informative, right? And like comparing drawdown to prior bear markets, also not that informative because the market is inflated in an unusual way that's probably never really been, you'd have to go back probably to the 20s, like 1920s, to see a similar inflation of asset values versus the underlying sort of real economy.
Oh, late 90s too, I think, at least on the technology.
Well, yeah, okay, yeah, no, I do agree with that, yeah. But that still is more isolated to tech, right? I feel like a lot of other sectors were not inflated the same way. Whereas like nowadays, everything's pretty rich.
Not my
But
Alice
in general, I
transmission
agree.
dog. I didn't mean to cut you off. I was just joking around. Yes, I think when you look at the index levels, though, and we've talked about this, the forward PE is like it's deceptive right now because people still have not marked down their 2023 earnings estimates enough, I think is my viewpoint, and it seems like the viewpoint held by many out in the market. I'm sharing, Ed Yard and his team puts out their own research, and they put out some good graphics on a regular basis. But like the forward PE in isolation, if you take the consensus at where it stands today, it doesn't look crazy rich. On the growth side, it's at 20. On the value side of the S&P 500, it's at 14.4, which isn't crazy. At least the value one is not crazy. The growth one is elevated relative to much of history. It's maybe not crazy compared to some of the bubbly eras of like 99 and I guess with now hindsight 2021. But that's where I keep not understanding why these estimates. I mean, I guess I do understand why the estimates are so high. Like no one wants to necessarily be the front runner and doomsayer on the sell side, but like the S&P earnings estimates are still like 230, I think, for 2023. And when you start to slice earnings down by 10%, 15%, from where the estimates are, those PE ratios naturally expand because of the E getting cut. And it's just, it doesn't make sense from a just intellectual, like trying to think rationally basis that earnings would be at all-time high levels in a deteriorating economy when margins were already at all-time high levels. Like, it's such a, to me, it seemed like such a more hope than reason driven thinking. Again, I have the graphic for S&P EPS estimates, and you can just see, like, for the preceding decade, the S&P averaged, let's call it $125 in operating earnings per share for like the 2010s. And yeah, there was a huge jump during COVID from all of the stimulus. And 2023 is still being estimated to be just like a complete, it's literally estimated at, like 40% above pre-pandemic earnings levels. There's just no way. Am I wrong? What am I missing?
No, you're absolutely on point.
Yeah, I think you hit on a piece of wisdom there when you talked about that they're coming from the sell side. And right, like it's in the name, the whole purpose of the industry exists to sell securities. And you can't do that when you are putting out research that suggests you should be selling them ahead of the broker dealers that are trying to unload their books or facilitate client flow to earn their commissions, right? Like it doesn't, they have an incentive to keep those earning estimates as high as possible, as long as possible. There's plenty of statistical research showing that like the sell side earnings estimates are not particularly informative to making investments off of. So I think, if you want to look at forward-looking expectations or assess how rich the market is, forward PE is not like a great metric to use. If you'd like take the Buffett indicator, for example, right, like market cap over GDP, or I personally like Tokens Q or some derivative of it, where you're looking at total enterprise values across the market divided by the total corporate net worth. Like they're all at 2000 bubble-ish levels still, even though the market's come down as much as it has.
Yeah, I'm looking at currentmarketvaluation.com has data on the Buffett indicator, and I'm sharing the visual again in the book server and for folks listening to the recording. But yeah, it's still a standard deviation above the historical trend line. Even with this, big drawdown, right? The U.S. stock market value to GDP is still north of 150%, and at the peak of 2000, it was 100. In the dot-com bubble, it was at 150%. So, on that basis, it certainly doesn't look cheap in the context of over a long duration. You would think you can't grow faster. You can't see values rise in perpetuity faster than underlying growth, right? Like you think rationally, and not saying that the market's always rational, but long term, you're buying that equity investment, you're buying its future earnings, you're looking to see earnings per share growth. Really, you're looking to see free cash flow per share growth. But if the economy is growing at, let's call it a little less than 2%, and this delta where valuations are just stretched far above what economic growth has been, it just doesn't seem like it can continue forever. Clearly it's going on.
It can, as long as the discount rate falls faster.
Right. Well, unfortunately, we have inflation now, and it doesn't seem that it's going away overnight. And we had a good conversation actually on Wednesday about this. Steve, I think his last name's pronounced Ho. He works at Bloomberg, and he's put out some research just kind of talking about, you have transitory aspects of this inflation, but you also have real significant structural shifts in the world that have happened. This decline in globalization that's going to be happening. There's, I guess the thing is, like, the Fed only had talked about transitory, but his point, I think it's valid, is that the things that were tailwinds for inflation staying under control for the last 40 years, many of those have shifted and are now headwinds. And while the Fed may be correct that the transitory components, the supply chain kinks, do resolve themselves eventually, that there are these other structural aspects now that inflation, the 2% era of inflation may be behind us and may not be coming back. And when or whether the Fed opts to change its approach on that target point, right, it remains to be seen. It certainly doesn't strike me as something they're going to be doing imminently, because that would harm credibility. But I don't know. A lot to think about.
Well, I think you're right that there's a permanent component, but the Fed also doesn't admit it. Like, it's very rare for it to admit mistakes. So even just the whole pivot from it's transitory to we actually need to raise rates was, I think, put off as long as possible, right? And if there was any other way, they would have found some backdoor channel to try and tighten conditions, but it's just simply impossible without raising rates. But yeah, like, there's a big piece, I think a lot of us, myself included, was caught off guard initially thinking like, yeah, it's just supply chain, and it's not, right? Like, the whole dynamic to work from home, and we have a service-based economy. A lot of those are white-collar jobs that can be done from anywhere, and that's a fundamental shift in the way that people earn income, and ostensibly increases wages in parts of the country that really weren't eligible to them before because they didn't have huge service-based employers there. there's like a lot of complexity there that needs to be unpacked. It's a good thought though.
Yeah, a lot to think about. So it's bottom of the hour. It's 5:30. We started around 4. I'm gonna let the conversation keep going another maybe 15 minutes. See if anybody else wants to chime in before we wrap up for the weekend. And maybe we can, Joe, maybe you can hit us with something a little bit more uplifting than talking about how everything is doom and gloom that we can riff on.
I mean, when it comes to the markets, I don't know what inspiration I can provide besides that. Don't reduce yourself to numbers too much. Get out, enjoy the day, enjoy. I don't know, where everyone's at. I'm in California. It's starting to get a little cold here. I actually realized that my furnace for the house doesn't work, so yeah, I had to suffer through 65-degree weather. Can you believe it?
I hope you bundled up, buddy.
I did. How about you, Riza? How's it in Florida?
My watch tells me that it's 82 right now.
82.
And when I scroll and I see that the next 4 days, next 3 days, the high is 88, 88, 88. I can't wait for winter.
Yeah? Yeah, I may have to.
Yes, Alpha and I are both from Long Island. Initially, he's still up there, and we both went to undergrad in upstate New York. And I'll just say, come December, January, February, that is not a part of the world that I wish on anyone to be living in.
Well, yeah, I mean, upstate is worse than around the city, but I'm
Yeah,
gonna
I
be
may need to
snowboarding.
find myself in Florida for the 183 days, maybe spend winter there. Like suffer through this harsh 65-degree weather here in California. It's so
It's
tough.
still
My
sunny
little
every day. So
New
like,
England
what are you
self.
complaining about?
Used to being about below zero, so maybe I can't complain.
You guys didn't get lake effect snow in Connecticut, but you guys will get cold up there. So Joe, you should be used to this.
I know,
Suck it
it's
up.
just like my body adapted, and now now I'm a pussy. But yeah, I mean, I still want to make it out to Florida this winter. Still visit you, visit the Wook team, and haven't been to Miami in over a year, so it'd be nice.
Yes, for sure. So I just thought of actually, Joe, may as well plug it. We will have it in writing shortly, but for folks that are interested, we hosted our first Wook book club last month, and I thought it went pretty well. It was fun. We covered Richer, Wiser, Happier, which I think is a really great read, regardless of your investing education level. You could be a novice, you could be an expert, and I think that everybody can walk away enriched having read that book. So Joe did post that recording if you want to listen to the discussion. Unfortunately, I butchered the video because I was using a laptop. I was in Vegas recording it, and I'm just a tech idiot, as you all can tell. So that's what we did last time. But we are going to do the next one the first week of December. So to give anybody a head start who hasn't read it or who wants to read it, we're going to be, again, Wook, my boss, Mr. John Kim, the founder, he's had the opportunity to meet Howard Marks before, and he has a ton of respect for Howard. And he had chosen the most important thing, which is a collection of Howard's client memos, which, if you've never read one of Howard Marks' memos, I mean, obviously you could, I guess, have your own perspective, but I think they're great reads. I think that there's always something to take away from them. But the most important thing, uncommon sense for the thoughtful investor, is a collection of Howard's memos. And that's what we're going to be covering the first week of December. We'll get all the formal dates and times out soon. But if you're interested in getting a early start on the reading, we will be covering that in our next book club meeting. And just to kind of recap, this is a Friday call that we've been doing now. This is our 7th one, this Wook in Review. We send out a little bit of a newsletter right up Friday morning. We host this at the close. We're a private investment fund that actually believes that we can generate alpha through crowdsourced research. And our intention here is not to sell anyone a product or service. We're just trying to provide value to people and hope that they'll become part of our kind of knowledge community, our network, if you will, and that we can all kind of become smarter investors together over time and make better investment decisions. So, that there's certainly more to come from Wook Capital on the investing front. Next week, I will be hosting a live earnings spaces for Playboy, PLBY, which is an investment that Wook has publicized that we hold. So I'll host that 4:30 on, I think it's the 9th. Jimmy, you probably know. But you are, I know, in the weeds with me on that as well. But we'll host it. We'll play the actual earnings call live over Spaces audio and then kind of go talk about what we've heard about the business. So it's obviously not an extensive written analysis that we'll be doing at that point in time during the earnings call, but we're going to look to do more of these sorts of things as we keep ramping up our social initiatives on the Wook side. So Jimmy, Alpha Hound, Joe, Sikwon, thanks guys for chiming in today. I think it's going to be a good point to wrap. It's 5:35 on the East Coast, so those of us who want to get our weekend started can do so. And again, this is a presentation of Wook Capital's Wook in Review. You can catch the recording on our YouTube channel, and we welcome any and all to join our Discord server at wook.gg. So thanks, folks, for tuning in. Hope you enjoyed it, and hope you have a great weekend.
You too, man. Catch you later.
See you guys.